You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Well, hello, ho, ho again, and welcome to the show, ho, ho. I'm Don McDonald, not Santa. He's not due for a while yet, so we're just going to wait. But in the meantime, we've got some great gifts for you in the way of money information. Help to get a more comfortable retirement started or concluded. If you need help with anything money-oriented, we will help you if you call us at 855-935-TALK, 855-935-8255. Now, we don't have any magic in our little bag of gifts because there isn't any, as much as you'd like it to be there.
I'm gonna tell you that there is. You already gave the number, right?
I think 855-935-TALK. Yeah, I did.
I'm gonna argue with you there. That,
there's magic in our bag. Oh,
Will Rind he's throwing a little of that dust they throw on top of Santa's bag there.
Will Rind?
Yeah, he runs Granite Shares.
Oh, see, I was
runs
thinking
an ETF.
Maybe the Watermelon Fund or something, Rind.
Exactly. He runs the Granite Shares HIPS U.S. High Income Exchange Traded Fund, or HIPS is the ticker, HIPS, as attached at HIPS. Here's the great news. I mean,
I'm looking it up right now.
The 30-day yield, because we're all looking to make some safe money, right?
Man, we want a better income.
Safe money. Yeah, because the U.S. government 30-year bond is paying like, what, 1.5? Or, I mean, whatever the stupid number is.
Below that, probably.
It's really low. The HIPS 30-day yield, 9.8%.
Wow.
Hey, give me some of that.
Wow, and over the last 12 months, it's yielded 11.36, according to Morningstar.
Yeah. Well, I mean, and then you dig into it a little bit, 41% in closed-end mutual funds, 29% in asset management and business development companies, 18% in real estate and trusts, and then there's always the 10.5% in master limited partnerships.
Oh,
just when
gosh,
we thought those were
MLPs.
going out of style, those come back.
Expense ratio.
Oh, yeah, how much? This is a super high Nova income fund.
Yeah, man,
friend.
so you're willing to pay up for this. To pay
to
pay 1.27% for this ETF.
Oh, yeah, well, I always pay that for my income funds, sure.
I mean, honestly, you could hire us as your advisor, pay us our highest fee, and
That's
the fee
true.
for all of the mutual funds.
That's a good point.
And you would come in below that.
I know. It's kind of shocking. Actually, more shocking is, yeah, the yield is the 9.8%, but the exchange-traded fund is down 21% year-to-date. That doesn't sound like a bond type of fund. I mean, because this is no.
Well, let me make it better for you. Remember, the yield for the year was 11, okay?
Yeah.
So you're expecting that would be kind of like your return every year. You know, I'm not expecting any capital gains, but, hey, that should be my yield. The average annual return, average annual total return, dividends.
That takes in everything.
Everything. The value of the shares, all of that. Over the past 5 years, 4.5% per year.
Total.
Total.
Per year.
Total.
So less than 1% a year.
No. That's 4.5 per year. No, that's
per year.
That's an average per year.
And what's the standard deviation?
But the fact of the matter is, it's supposed to be a high income fund, and over the past 5 years, you could.
I'm getting to the point now.
You could have done
you could have
that.
Owned the. You could have owned the Vanguard High Yield Bond Fund.
I want to look at the total market and see what it did over that.
Well, I bet the high yield made 6. I bet. Bet you right now. VWEHY.
Get this: the 5-year average annual return for the Vanguard Total Bond Index Fund. 4.35%, almost
and look
exactly
up the Vanguard
the
High
same.
Yield, and look up the Vanguard High Yield. By the way, that Vanguard fund you just mentioned has expense ratio of what, 12 basis points or something?
Less, I think, yeah. High yield corporate is 5-year return. You ready? Hold on. We're coming to
I'm
it.
saying 6%.
Oh, I bet
5.5.
I bet you're low. I bet you're low. I don't know though. Could be wrong. I haven't looked at it, so I'm working in the dark here. Oh, 6.5.
Yeah, pretty close.
You're pretty darn close.
Yeah. So, no, this is not a fund we would use nor recommend, especially for those of you looking for yield, income.
But these dudes,
Crazy.
these people who run these things, manage to get all this press for their overpriced, incredibly risky fund that has had a worse return. Now, this is an incredibly risky fund, folks. That is really important to note. It's a high-risk fund, and the average annual return has been the same as the entire U.S. bond market, which is far less risky and far less expensive.
And there's an expression, people have lost more money reaching for yield than at the end of a gun. This is why.
855-935-TALK is our number. We have lines open and a couple folks waiting. We'll get to them right after we take care of some other stuff. So give us a call, 855-935-TALK. It's free, it's easy, and it's your life we're talking about.
Tom and Don are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
For your real life and real future, Tom and Don are talking real money.
There's something about the future, and you need to understand this very important fact. If you want to enjoy it, you're going to need money. I guarantee it. And you're going to need a plan, because when you're not able to work anymore, or you're just sick and tired of doing it, you still need money. And Social Security doesn't provide you very much of it. So give us a call at 855-935-TALK. I'm Don, that's Tom. This is Talking Real Money, the show and podcast. Wow, it is multifaceted. And we've got tons of folks waiting on the phone, so we got to get moving. John, welcome to the show.
Hi, how are you guys?
Good, thank you.
Good.
Hey, I've been listening to you guys for, I guess about close to a month now. And I can best describe my financial situation as a tragedy. I am a 57.
I'm going to be crying again. Are you telling me I'm going to be weeping again like I was in the last hour?
Well, I hope not. But
All
when I tell you what my situation is like, you're going to go, wow. So I'm 57 years old, a federal employee, and I have I'm married. And I have a total of $25,000 in savings. I got started late in life, and I am just trying my best because I'm afraid that I'm going to be working until I drop dead on the job. And I'm just trying to figure out the best way to move forward and get some sort of retirement and some way of some comfortable living. Because I'm not going to be able to work probably past another 10 years.
Wow. Okay.
So,
all right. That's good. We got that.
It does verge on tragedy. It's going to be.
But that's okay.
Now, you work for the government.
Yeah, I have.
Are
my
you?
TSP. Go ahead.
That's what you're starting to answer. What do you have?
If I'm invested in my TSP, I do 15%. Withdrawal from my monthly paycheck, my biweekly paycheck. Investing in, I got the highest risk I can take tolerance.
Oh, you went with the S fund?
Yes, I went.
Which in the last month worked really well for you.
You look like a genius, John. You're up over 20% in the last 18 trading days. Well done, sir.
Well, thank goodness. But that's hard.
Nah, but that's not a good approach, by the way.
That's not going to put a biscuit on my table when I'm 67,
No. But okay.
Let me ask you another question, though, John, just real quick.
Sure.
That 15%, we need to establish a baseline. That 15% is how many dollars?
Offhand, I don't know. I have to see.
Off the top of your head, what do you make a year? I can do
Roughly.
it.
Yeah, so I make my base salary is about $57,000 plus. I'm a veteran.
Okay.
I'm 90% service connected, so I get another $20,000 or so. So I'm
Wait. Hold on. You get a pension.
Yeah, I'm a service connected disabled. Yeah.
Okay, great. So you're going to get that no matter what going forward, correct?
Correct.
All right. So now, basically, we got to fill about a $37,000 a year hole, right?
Yeah.
Well, that's not impossible.
That doesn't sound horrible in 10 years, actually.
Because you're putting away, about $7,500 a year, $8,000
Plus
a
the
year,
match,
plus the match.
which is another, 25, let's say 10,000.
Let's say you get just, a 5 or 6% return over the next 10 years. You're going to be looking at, you're going to be looking at over $250,000, $300,000.
I was going to say 250. Yeah.
So when you start getting to $250,000, $300,000, you're now getting into the realm of doable. Not comfortable, but doable.
Right.
Go ahead, Tom.
Here's the other thing.
What can I do?
Go ahead.
Well, I was going to say, what can I do right now to get comfortable?
I'm not sure I follow.
Well, you said in 10 years, the way I'm going right now, it'll be doable, but it won't be comfortable. So I'm saying,
he wants to know how he can get comfortable. I don't know that you can, because here's the thing. I mean, if you really do need to replace $37,000, as Don suggested,
well,
that's going to be a pretty hefty withdrawal rate on $250,000.
No, but here's the other thing. I know a lot of people, John. Now, when you are 67 years old, even though you are disabled, your mind still works, right? You have a few skills. I would be willing to bet you could find part-time work that would put $1,000 a month in your checking account. I'd be willing to bet. Even if it was working as a greeter at a Walmart. You could
Don just got paid to be Santa, so come on. Come on.
You don't have to work full-time to continue to supplement that income as needed, to be comfortable, as I said.
Right.
So there are a lot
Here's
of
the way
options.
I look at it.
I would just go for I would build the right portfolio for you right now. Tom, I'm going to let you do this part.
Well, and so here's what I would do. I would build at 57, if you want to be very aggressive, I would go 80% in stocks. That would be between the U.S.
C and S.
Well, no, you
CNS
gotta be
and I.
international in there too.
CNS and I.
And maybe you put a third in each one of those. And then you put the remainder in stocks.
Bonds.
Right? A third in bonds in the government bond fund, the G fund.
Mm-hmm.
So you put a third in each one of those, then the other whatever's left
in the G fund.
In the G fund. Mm-hmm. And then you just keep doing that. And you take the match and you go on. And by the way, you could do that for 5 years and then look and see where you are.
Mm-hmm.
We know of no other sort of magic approach than putting your head down, saving the money, and doing that.
And if you keep doing something like the S fund, which is really risky, you could end up in 10 years, with a lot less money because of the higher level of risk.
That's the struggle. That's why I was saying look at it in 5 years. Here's another thing to think about. If you truly were able to do what Don also suggested, that is, if you could somehow bridge the gap between 67 and 70 with some other source of income, something, and then not have to draw on your portfolio till age 70. Ooh. You could be more aggressive. This is my plan for personally. I'm going to be able to draw more aggressively because I'm not going to start pulling on that money. I'm hoping for 90 years, but I don't know if I'm going to get another 20 years after 70. So you could afford to be a little more aggressive there. I would do that 80-20 or so. I would use those funds. I would check it again in 5 years just to see where you are, and then get very serious about the retirement income.
All right.
What about a brokerage? I mean, because I'm with TD and No.
See, you're talking about getting into taking too much risk.
Okay.
Do you have? Wait, let me just one more thing. Do you have extra money over and above the 15% that you're putting into your TSP?
Yeah, because I'm saving $500 I'm saving $500 a paycheck. And
Great.
I was thinking
Then
about
go to
putting
Vanguard.
that in-
Go to Vanguard or go to TD. If you're with TD, put it into VT. The VT ETF. Don't try to pick stocks. Don't try to play the market. Don't try to rescue yourself with Hail Mary moves, because if you watch football, you know the Hail Mary almost never works.
Tom and Don are talking real money.
Before you end up buying a financial product that you'll regret later, either call us on the podcast or the show, or if you need a little more time, that's why we offer free meetings with our fiduciary advisors at Vestory with no cost, no obligation, and no high-pressure sales pitch, I promise. Just give us a call at 800-386-3004, or better yet, just set up an appointment at vestory.com, VESTORY.com.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-TALK is our number. Give us a call.
And just to close the book on John a little bit, here's another thing. The VT is a great idea. He could put that in a Roth. He's Roth eligible. He could put it in a Roth IRA. Then it grows tax-free. Nope, shaking his head.
I disagree. I would put it in a tax advantaged account right now, take advantage of the deduction, because he could do an IRA. He's eligible. He could do an IRA, and
that's true.
And
okay. Yeah.
He's going to be in a very low bracket in retirement.
The point of the matter is to put your head down, start saving, to build the right portfolio. And as you said, don't think you're going to pick the next Zoom, or I guess I should say Tesla now, because it could go the complete other way and you could lose everything. That is not a good approach at this point at 57.
And you don't want it. You don't want to take risk. You want to take smart risk, and that smart risk is taking the risk of volatility. You see, the only risk we want you to take is volatility. We don't believe, if you follow what we suggest, that you have any risk of losing everything. There's just no risk.
Well, the asteroid.
The asteroid hits the Earth.
You don't care about money so much. Atmosphere might be more important at that time.
Even the entire Antarctic could melt, and you're still going to have a portfolio. Maybe. 855-935-TALK is our phone number. Rod, you're next. Welcome to Talking Real Money.
Happy holidays, Rod.
Happy holidays to you. Good afternoon.
What's new?
I had a sort of a terminology clarification question.
Sure. Yeah.
And it has to do with bonds and bond funds. And it's taken me a while to sort this out, but one hears that when bond interest rates rise, that the value of bonds goes down.
Yes.
And it always puzzled me because I thought that always puzzled me because I thought a bond was an agreement between a borrower and a lender, or an entity and an entity and someone who is loaning the money.
It is. It absolutely is. But you see, we're talking about in the secondary market. That's
my exact point. I realize now that what's really going down is the resale value of a bond is going down.
Trading.
The face
That's
value
correct.
And the interest yield. Like if I owned a particular bond, if I held the piece of paper in my hand, its value would not go down. It would continue to pay me so much percent per year. And I just
That's correct.
Unless
think that's not made clear to listeners that what's going down is the net asset value, which represents the resale value of a particular bond. Is that correct, or is that not right?
That's correct.
Well, that would be the bond fund, the net asset value.
When we're talking about bond funds, but see, there's a difference between bond funds and individual bonds. If you own a bond and you plan to hold the bond until maturity, your bond will mature at face value.
Well, now, I would interrupt you there just real quick, Rod, because if you hold an individual bond, it could default. So that's why we don't, just like individual stocks, we don't recommend individual bonds. Part two of individual bonds is, and this is the part that most people don't understand, they're generally expensive to buy. It looks like the broker's giving them to you. There's a spread there. You don't know what you're paying, et cetera, et cetera. So we use bond funds. You get a lot of bond. Don mentioned in the Vanguard Total Bond Fund, there's 12,000 securities. So you get the risk of default really kind of goes away, and you get some interest rate that deals with rates a little bit.
But you were really talking more from a defining perspective, a definition perspective, right?
Yes, I definitely wasn't recommending that people own individual bonds. I was just thinking more from a teaching point that I don't think one hears often enough that it is the net asset value of a share of a bond fund that's going down, not the value of a particular bond. And that's you
just helped us do that.
Once in a while, you just throw that in. It's, that's what we're talking about. And anyway, otherwise, I greatly appreciate your teaching and the way that you explain stuff, and also the very good advice about indexing, and definitely caused me to pay much closer attention to expense ratios and whatnot.
And I want to thank you for helping us in our teaching efforts. We appreciate it too. Rod, take care. 855-935-TALK is our phone number. That's 855-935-8255. You can call that during the show or 24 hours a day, 7 days a week.
Tom and Don are talking real money.
There's a science to managing money. I call it financial physics, and you can get a free copy of my easy-to-read book, Financial Physics, at talkingrealmoney.com/free, or there's an interactive version available on Apple iBooks. It's called Financial Physics, that's spelled with an F, and you can get it free at talkingrealmoney.com/free or in the Apple bookstore.
Reality radio for a really great future. We're talking real money.
We've been a whole lot busier than I expected for the Saturday after Thanksgiving.
The tryptophan hangover is gone, and you're back.
That's right. I'm done. And I've pretty much eaten all the little turkey. It's only an 11-pound turkey. All that's left is a little dark meat that's going into a pot of chili this week.
Pot of chili, and here it's going to be turkey enchiladas.
Ooh, that sounds good. A nice enchilada.
I think it's going to be very good.
Nothing like an enchilada.
Yeah. Get the weekend going.
Too bad I'm 3,000 miles away. No enchiladas for me.
Sorry about that.
Hey, our number is 855-935-TALK, 855-935-8255. Call. We'll talk about money with you, your money, and how you deal with it, and how you avoid all the people who might help you deal with it badly. We've already had one of those questions in the previous hour of the show, which is the previous day's podcast, but we'll take another one. We love those. 855-935-TALK, and Gordon is next. Gordon, welcome to Talking Real Money.
Hi, Gordon.
I'm 61 and retired, and I have a disabled son, and I'm in the process of working with a lawyer to set up a special needs trust for him. And I want to be able to invest money out of my 401k when I die into a Vanguard fund. And I'm wondering, do I need to engage Vanguard in creating a special trust fund, or can I use a standard brokerage account to hold that money?
You could use a standard brokerage account and use the ETFs.
Okay. Well, no, but you do need a special account for the special needs trust.
But if the brokerage account is already in the special needs trust, then you could buy Vanguard through that. I was making that leap of.
Yeah, the titling is very important there.
Yeah.
That's correct.
So the trust accounts, they charge like 1.5%, and I was wondering if I could avoid that extra fee if I have a trustee already in my family. Do I need their assistance in managing?
The short answer is you don't have to pay Vanguard to be the trustee in that circumstance if you already have one. They're simply going to hold the investments, and you would not have to pay them 1.5%.
No, and the trustee would give them their directions. The trustee would be the trust manager.
Yeah.
No, you don't need a trust company to create a trust.
I could use a standard account then.
Yeah.
Correct.
Again, it just has to be properly titled.
Right. It has to be the trust's account.
Right.
Which can be created as the trust's account as a successor trust, though.
Okay.
This is where your attorney is handy, but in terms of you don't have to have a trust account to do this, and there's no need to get with Vanguard prior to, because the trust is going to take care of what happens to those assets after your passing.
I'm trying to set it up in advance so that the new trustee.
No, but that's what I'm saying. Your trust is going to tell is going to tell your trustee how to move the money into the right places and do the right things with it.
Yeah, you're doing everything right, Gordon.
Yeah.
Okay, good. Thank you.
All right. Thank you very much. 855-935-TALK is our phone number. And Sri, welcome to Talking Real Money.
No, Amir was first, wasn't he?
Who? I don't have that.
I have it.
Oh, my gosh. My little system's not working. Who is next?
I think Amir was next.
Oh, Amir is next then. I'm sorry, Amir. I didn't see you on my
apologize.
screen. Hi, Amir.
Hi, how are you, sir?
Good, sir.
You guys got a lot of knowledge, okay, and you help a lot of people. So I listen to you all the time. So I thought that I do have some money, so why don't I just get advice from you guys? So I've got like around $300,000 cash.
Yes, sir.
And I want like a 5-6% every month coming to me. What should I do?
Don't count on it.
Yeah, 5.
We don't. No,
but you
where are
might. I
gonna
said
go
might.
get 5?
I used the word might.
Because right now, let's just go through the drill.
All right.
U.S. stocks dividend. Do you know what they're after this whole COVID thing? Do you know what it's down to? I just looked at the dividend yield for stocks today.
1.5.
Yeah, it's exactly it. 1.5. 10-year government bond paying
1.2. I don't know.
The Vanguard High Yield Bond Fund.
No,
is
too
yielding,
junky.
I know, but I'm just saying. I'm just trying to give you the universe of things you could do. I'm not saying do them, but that's still only paying like I think 2.5 or 2 and 3. It's 3. It's a very small number. So Amir, there is no, and this always comes up. Sort of. Oh, I just want to get 5% on my money. The only way I know to do that is to have one of those Wayback machines that takes you back like 10 years and sets you up in something.
And I
that
keep
would
telling
pay
my
that.
wife you can't do that. She says, I just want to go back. No, you can't do that. You might be able to get 5%, but to get 5%, Amir, is going to require taking a degree of risk. It will probably require a balanced portfolio, about 50% stocks, about 50% bonds, but there's no guarantee you'll get it.
Don are talking real money.
Everybody needs help with their money now and again, and if you need more help than we can give in the course of this podcast or show, set up an appointment with one of our advisors for a free actual meeting with no obligation and no high-pressure sales pitch. Just go to vestory.com, that's VESTORY.com, or call 800-386-3004.
For your real life and real future, Tom and Don are talking real money.
Just for the heck of it, during the break, I went and looked up the yields on fixed income securities, because we were talking about treasuries, and a 1-month treasury is paying less than 1/10 of 1%. A 10-year treasury is
Give
paying
somebody your money for 10 years.
10 years paying
and you
less
get
than
how much back?
9/10 of 1%.
Ay, caramba.
And a 30-year treasury,
Yeah.
you're getting about 1.8. 30 years.
And
Well, the
the
Vanguard High Yield usually what,
4.7?
The
junk
4.9.
4.9.
4.9%.
And
And
in 2008,
yeah,
that fund lost just shy of 25% of its value.
gosh, that sounds.
So if you're okay with that, then go right ahead.
That sounds almost like a stock fund to me.
Well, it's amazing how junk bonds and equity prices look very similar.
You just can't. There's no magic. There's no magic in the world.
When there is, call us.
Yeah. 855-935-TALK is the number on which to call us. 855-935-8255. Now, Sri, your turn. Welcome to Talking Real Money.
Hi, can you hear me?
Yes, we can.
Yes.
Okay, thanks. I have two questions. So currently, I have this question is about the 401k. So all my money in 401k is in growth. I think funds.
Is it what? Wait, 3
gold funds.
Oh, gold funds. Okay.
Yeah, keep going.
No, not gold, but not gold. Growth funds.
Oh.
Growth
so
funds.
I have
Got it.
Growth funds.
Yes.
Okay, better. Okay, thank you.
Yeah. So it's pretty aggressive, and I don't have, I haven't diversified my, 401k investment. But I just wanted to know that, I've been hearing that, you need to diversify in such a way that you have something in bonds and various things. In case of any, a huge recession or any, case of, downfall, what kind of bonds should I invest wherein I will lose very little?
All right, so
Okay.
let's go back.
Wait, you said lose very little, so
Yeah, very little.
I need
'cause
you to be
just heard
careful
us-
here.
Well, you just heard us talk about the fact that they're paying very little too. I want to make sure that's clear because the reality, by the way, for anybody investing, if you just want to make more money, you're willing to see your portfolio go up and down. Stocks are the better place to be, have been the better place to be. By the way, in addition to growth, we think you should own value because value has been a very large outperformer of growth for an extended period of time. If it was a safe bond fund, I would own an intermediate term government bond fund. That I consider safe. Your maturity averaging 5 to 7 years. As Don just pointed out, your yield is less than 1, but you're going to wake up every day and your money's going to be there with very little change.
Yep. That's it.
Okay, thank you. Can you still hear me?
Yes, sir.
Yes.
Okay. The second question is about 72T. So I'm actually planning for early retirement, and I'm looking at options where I can get equal payments monthly from my 401k. So I just need some suggestion on the 72T because I need some some income coming in from 401k on a monthly basis if I'm retiring early. Even if it could be low, but I still need some money coming out. So I just wanted to explore the 72T option wherein I can get the SEPP, the sequential equal payments or something. Just
Basically,
need some guidance on that.
annuitizing your 401k. That's what that means.
Honestly, if I was going to do that, I would go see a fee-only advisor before I even got close to touching that. Because once you do that, that's a big deal.
Yeah, you need
So I would
to
go
run.
see somebody.
You need to-
I wouldn't do that over the radio. Wouldn't be good.
Yeah, you really need to sit down with someone and explore the options because, as Tom said, once you do that, that's forever. And thanks for the call, Sri. We really appreciate it. Let's see. Up next, I got to get my thing to work here. Tuan, you're on. Welcome to Talking Real Money.
Hello.
What's up, Tuan?
I'm driving, so it's going to be a little bit hard. Can you hear me?
Yes, we can.
We do.
Okay. So I have two questions. First one was, let you know that I've been a long-time listener to you, but a first-time caller.
Thank you.
Thank you.
Yeah. I always hear you say advocate Vanguard over Fidelity. And I have
No, not
Fidelity,
anymore. Not anymore.
No.
We love Fidelity now.
Oh, really?
We
good.
actually, on our website at talkingrealmoney.com, we have a list of funds that we think make sense at Fidelity, Vanguard, and Schwab.
But what's your question, Tuan? Go ahead.
My question is, I have a TSP account. I get a 403k, and I got about 6 more years to retire. Should I transfer that money once I retire over to Fidelity, an index fund? I have a Fidelity Spartan 500 index. Should I transfer that over?
The short answer to that is maybe, because here's the thing. The TSP has very low costs. It has decent diversification. At retirement, I would prefer, and I'm assuming the money you're talking about would go over to an individual retirement account, which is where it should go. And I would not just own the S&P 500 either. In the TSP, you own other asset classes. So there isn't one right or wrong answer there. Don?
Yeah, I agree. When you get to that point, you really need to explore your options. But for now, I think, as we say to everybody, the best portfolio is the most diverse portfolio, where you've got as many asset classes as you can get in the circumstance you have, in the account you have.
And it's been proven this last month, again, with U.S. small value up over 20% in 1 month, again, showing you why you want to have some of your money exposed to small and to value. I think we're at time to squeeze in one more here. No?
Just barely
All
time. Right. Ali, welcome to Talking Real Money.
Yes, sir. I do have cash money like around 100,000 to 200,000, and somebody told me that the Delaware state you know where the Biden lives, the new president, Delaware State Fund?
Yes.
They pay 5% for 5 years, in 5 years.
Who said this?
One of the contractor, because he has got 4 houses, and he puts all his money there. So he says they pay for 5 years, 5%. Delaware State Fund.
I got it.
Don't do it.
Yeah, it's really risky. It's incredibly risky. Ain't no doubt
What's he
about
talking
it.
about?
A real estate fund. A real estate fund.
Real estate fund.
Yeah. Okay. It's really, really risky because you're in an asset class that can be very volatile. As a matter of fact, there are going to be a lot of real estate funds. My guess, with the COVID situation, it's going to be we're going to see a lot of real estate funds go out of business. A lot of people who thought they were getting a nice, safe dividend are going to be surprised. The risks are high. And let me explain to you, Ali, and to everyone listening.
Thank you.
Anytime you see a return that is higher than the safe money return, which today is 1% or less, then there is risk involved, and it's commensurate with the increase in return.
And real estate funds should not be compared to government bond funds.
No.
They are two completely different things. Remember, a REIT needs to collect the rent. It's got to be properly invested. There's all kinds of factors that go into that. When you own a government bond, you're relying on the full faith and quality of the United States. Two completely separate things. Please don't compare them.
I mean, literally, I would say a 5% yield is 5 times riskier than going out and buying a Treasury security. I really believe it. Now, you may not see the risk right away, but someday it comes back to bite people. It does.
Tom and Don are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
Your guides to a really great financial future. Tom and Don are talking real money.
You know, it seems to be just a few minutes ago, Tom said, there are times when you need to just sit down with a fee-only advisor and go through all the options. And that's why we make our advisors at Vestory available to anyone at no cost, no obligation, with no high-pressure sales pitch. It is really easy, and you will get help that is actionable. Just go to vestory.com and set up an appointment. That's vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?